Here's the question from me. What risks are actually worth managing at the moment? Because for a lot of people, they're being rewarded by just ignoring pretty much everything.
It's amazing, John. It reminds us a bit of the Talking Heads song, Same as It Ever Was. Just looking back a week, you saw the typical geopolitical risk management narrative playing out with the dollar briefly catching a bid. You saw oil prices obviously higher, gold getting a bid, and all of that has quickly reversed. This is one of the biggest head fakes that we've seen for investors in quite some time. And now we're once again spitting distance from new all-time highs, sitting at 21 and a half time forward earnings. Investors are chasing the riskiest areas of the market, really embracing a momentum-driven strategy, looking at pockets like unprofitable mid-cap growth stocks and European equities is really the playbook this year. So really very little risk priced into the markets, high yield bond spread sub 3%. Markets seem to be calling the all clear here. We think it's more important than ever to consider risk management.
Max Kenner of HSBC asking a question, and I'll quote him directly. We think the biggest risk to our view is that we're not bullish enough. Ali, what are you suggesting people do then? Fade these moves? If so, how? Rotate out of what and into what?
Totally agree. This market is just pushing you into risk, John, and it's been really hard to resist that momentum. This technically driven, sentiment driven market has been a big challenge. It's not to say we don't have exposure to risk assets. We still love high quality stocks, ones with great earnings potential, good ROE, lots of cash. We're looking to find quality at a reasonable price. So we're finding it not only on the growth side of US markets, but also in sectors like healthcare and utilities. We've been talking a lot with investors about infrastructure related assets. So these are the things that people need versus the things that they want. Look, the economic growth trajectory in the US isn't great. It's not terrible, but the data have disappointed. We're starting to see cracks in the labor market. The consumer's coming under pressure with retail sales disappointing. So we want to be positioned for that environment, but markets are almost completely ignoring it and trading on a different planet. We think there's opportunities to trim risk here. We still think that the elevated yield available in bonds is very attractive here. Stocks are priced for perfection, and bonds to us are still mispriced for this disinflationary, slower growth environment that we see playing out through the back half of the year.
Emily, if this is truly a disinflationary environment, then maybe Michelle Bowman and Chris Waller are onto something, and the Fed should be cutting potentially as soon as next month. Is that inconsistent with the idea of the resilience in U.S. equities, or does it help fuel it?
For now, it helps fuel it. So you remember we talked a long time ago about the pivot party. There's a period where rates are coming down, disinflation's coming down, growth is slowly slowing, where equity markets are going to celebrate that because we know that stocks love a lower cost of capital. But then there does become a point where bad news is just bad news as it relates to growth. We think right now we're still sort of in a celebratory environment where disinflation through housing and shelter is playing a really key role. We actually do think that some of the recent Fed speakers, it makes a lot of sense. In fact, the Fed, if they were data dependent, they may be cutting already if it weren't for the specter of tariff driven inflation. It was amazing to hear Powell last week say that every forecaster he knew suggested that inflation on the good side was going to pick up over the next several months. I don't know, maybe he's not reading the weekly emails that Matt Miskin and I are putting out there, but we've been highlighting the fact that housing and shelter disinflation, which is a much bigger component of overall inflation, is significantly slowing, which we think could actually offset the potential inflationary impacts of tariffs here.
If the Fed doesn't cut for the remainder of this year, do you think that that alone could actually accelerate a downturn in the economy and actually could end up leading to a protracted bout of weakness?
Yeah, I mean, you think about higher rates having this almost self-limiting mechanism where, you look at mortgage rates, picking up around 7%, that housing is completely unaffordable for many Americans right now. You think about credit card debt, auto loans all being elevated. There's a limiting factor that takes place the higher that rates remain that we think actually pushes growth lower. So we think it makes a lot of sense for the Fed to consider cutting here. It's probably, in our view, back end loaded as it was last year. The Fed obviously doesn't want to kowtow to any pressure from the executive branch in Washington. We are watching that really closely. So we think maybe they give us a little bit more color at Jackson Hole in August, probably not doing anything anytime soon, but we see the case for more aggressive cutting than markets expect as we look at the sort of later stages of the year.
So, Emily, what are the investment ideas you've got around that view? Do you sit at the front end and ride the rally on a 2-year save? You expect that deep cutting cycle that's not priced in? Are you moving out of cyclicality in the equity side of the portfolio? What are you suggesting people do?
Yeah, on the fixed income side, we're looking at the intermediate part of the curve, areas like MBS, investment grade corporate bonds, single A, even treasuries. We're looking at a benchmark level of duration, so right around 6 years. We're not going all the way out to the long end of the curve. The challenge, though, with sitting in the short end of the curve is investors might miss out on the total return potential that is at play here in high quality bonds. The most popular investment within fixed income by far is still money market funds. We're sitting over $7 trillion in cash right now. The advisors that I talk to when I'm traveling say that their clients want to roll over those CDs and continue rolling them over. The challenge there is that investors tend to embrace money market funds all the way until rates are zero, and then they look to bond investments after a great period of performance. So investors tend to miss a lot of that duration benefit. So we're suggesting legging into duration, looking at the intermediate part of the curve, fading the momentum, sentiment-driven rally in areas like growth at any price stocks, European equities, which have been rallying on negative earnings growth, and redeploying that into a mix of high-quality stocks in the United States that are trading at a reasonable price.
Emily, beyond equities, I just want to finish on the bond market. There's an important assumption that we've all got to make a decision on. What happens to the long bond if growth does decelerate, if rates are cut at the front end, which is what the Fed controls, Fed funds? What happens to the bond at the long end?
Yeah, I mean, we think that bond yields fall across the curve here. We've seen this really unusual environment where this bear steepening has played out. That doesn't happen very often. And really, there's an argument out there that politics are driving that. There was a huge question. You guys asked every single person that came on over the last few weeks, are you buying the 30-year Treasury at 5%? We don't think it's the worst idea to own, look at every backup on the 30-year as an opportunity around 5%. There's a lot of volatility there, so you've got to right size it. But we do think ultimately yields across the curve come down here as growth decelerates and disinflation sets in.